Thanks for joining us today on Market Call. I'm Marilla Fernandez. Stan Wong with us on the show, portfolio manager at Scotia Wealth Management. He'll take your questions on North American large caps and ETFs. Here's how to reach us. 1-855-326-6266 if you'd like to dial in. Market Call at bnnbloomberg.ca if you'd like to send an email. Good to see you. Thanks for coming in.
Nice to see you. Thank you.
We've got oil prices, of course, whipsawing around. Do you have concerns about energy prices yet, putting pressure on inflation, upward pressure for the later part of the year?
Certainly if we see oil prices sustainably above $100 or even $95, that's going to change the narrative quite a bit. That's going to affect the macro outlook quite a bit. With that being said, I think that things will calm down in the next little while, and oil prices might come down a little bit. We continue to navigate this very complex backdrop of geopolitical tensions, and supply chains are changing because there's more onshoring and nearshoring that's happening. Behind all of that, consumer spending is still strong. Corporate balance sheets and corporate earnings still look to be pretty good. We're looking at 13% earnings growth this year and 15% earnings growth 2027 forecast. Employment numbers continue to be pretty sturdy as well. So that economic backdrop continues to be solid. But of course, the wild card is the energy markets.
Yeah, you said you expect the conflict to wrap up sooner than later. At what point does it become more of a pressure point? I mean, we're hearing a month, 6 weeks, but then some are saying, look, it could be longer.
I think when you look back at history, geopolitical events like these tend to have a short-term impact, but really rarely have a medium-term or long-term negative impact on markets. So I would look at this environment as being an opportunity to pick up high-quality names or names that really don't get affected by what's happening around the world. So we saw that last year. We've seen that many times before in history, whereby we have some sort of geopolitical shock, has a short-term impact on markets, and then a month later, 6 months later, 3 months later, markets are back to normal.
Would you chase energy at this point?
I think it's a little extended at this point. I think some of the infrastructure pipeline names look okay. We do like energy for more midterm, but probably a little bit overbought at this point for me.
Okay. Let's take a quick break then. We will be back with some phone calls for Stan Wong of Scotia Wealth Management, taking your questions on North American large caps and ETFs. Back in a moment. Welcome back to Market Call. We have an email from Mona. She said, should we buy AMD stocks or will it fall again? We'll have a look at advanced micro devices. Where are you on tech these days and stocks like AMD right now?
Well, I mean, I would say that the Mag 7 has kind of become a bit of a lag 7. You want to be careful of some of these hyperscalers that are spending hundreds of billions of dollars in CapEx going forward. I think the AI story is very, very much alive, but how do you play it? And we'll talk a little bit about that later in the top picks. So AMD is still, the AI and data center chip maker, but it's become a bit of a prove it story because it's had some issues in terms of earnings and its ups and downs and so forth. Lately, it's been moving a bit higher. It's above the 200-day moving average, which technically makes it a bit sound. But I think if you were to choose between AMD and NVIDIA, NVIDIA is definitely the leader. And AMD is still lagging there. And I think really, again, it's a show me story at this point. I would prefer NVIDIA, and we have that in our portfolio.
Got it. Okay, that was for Mona. Let's go to our first caller. Craig on the line in Kelowna, BC, with a question. Hi, Craig.
Good morning. Thanks for taking my call. Stan, the question's about my daughter has about $32,000 in her FHSA. And I'm looking for some advice on maybe sort of 5 ETFs, some Canadian exposure, some international exposure, and some American exposure. So just some ideas if I should just do like total market returns, if I should get into things like XFN, VDY. What would you recommend? Thank you.
Okay. So because he wants that much exposure broadly, would you recommend a couple of different ETFs?
I think you could, assuming you have 4 to 5 years before the home purchase, you can be in an equity strategy. On the Canadian side, high dividend strategies such as VDY would make sense. High dividends tend to do well in Canada. Or XEI is an ETF that you can consider through iShares. With the US, obviously lots of different options out there. I'd stick towards the equal weight ETFs rather than the market weight ETFs. The S&P 500 is still 45% tech and communications, and I think that's a little bit risky at this point in terms of weighting. So RSP would be one symbol in the U.S. that you can consider. It's an Invesco S&P 500 equal weight ETF. And with regards to European or international markets, you can look at just a broad base strategy. I think VIDY is a symbol that you can consider. That's the Vanguard FTSE developed ex-North American high dividend yield ETF. So there's a few ideas there. Again, assuming we have at least 4 or 5 years of timeline to invest in equities, which can be volatile.
Okay. Let's move on to our next caller. Elliot's in Hamilton, Ontario. Hi, Elliot.
Good afternoon. I'd like to add an American Financial to my portfolio, and I'm looking at JP Morgan or Citigroup. I can't decide. Both are under distress. On a technical basis, which looks like it might be the better buy, if either, today? Thank you.
Okay, JP Morgan or Citigroup?
Thank you for that question. So we do like U.S. banks, large banks. I think they'll continue to benefit from deregulation and a pretty sturdy economy in the U.S. From a technical perspective, and I'll say that we own JP Morgan, not Citigroup at this point, but I do like both names. Citigroup is holding above the 200-day moving average, so that's a little bit stronger. JP Morgan's fallen a little bit below that 200-day moving average more recently. So I'd argue that Citigroup actually has a little bit of a better sort of technical profile at this point. In addition, Citigroup has a lower price to book relative to JP Morgan. With that being said, JP Morgan probably has a bit more growth ahead of it in terms of earnings per share.
All right. So almost split in different ways, but something to chew on for Elliot there. Let's go to Chris in Delta, BC. Hi, Chris.
Oh, good morning, Marilla and Stan. Thank you for taking the call as always. Stan, I'd like to follow up with another U.S. financial that I've done well with in the past, but long since sold out of, which is Bank of America, and wondering if it sort of falls under the same thoughts that you've just shared about J.P. Morgan and Citibank, and if it would be between your pick today for a I'll hang up and listen. Thank you very much. Bye.
Okay, thank you for that question. Go ahead.
You know, I have to say that I like all three of these large banks, and you can add to that Goldman Sachs, which we hold in the portfolio, and Morgan Stanley. Bank of America has fallen slightly below the 200-day moving average, so you'll want to sort of watch that technical development. But they'll also benefit from a sturdy economy, a strengthening economy, and also more deregulation from the U.S. administration and so forth. You're getting a 2.4% dividend yield, which we expect to be solid going forward. Of course, Citigroup would probably be your least expensive name from a price to book perspective, but we like them all. Citi's probably the most technically sound at this point, just given the fact that it's stayed above its 200-day moving average. I'd probably choose JP Morgan next and then Bank of America thereafter. But Goldman Sachs should be up there as well because we own Goldman Sachs.
Are any of them in a clear way beginning to benefit from AI in the back room?
I think that AI is benefiting a lot of different industries and sectors. I think from a productivity perspective, it's helping provide better client experiences. It's helping from a fraud perspective, detecting fraud within the banks as well. So there are definitely earnings accretion from AI. Hard to quantify that today, but it's certainly helping.
Okay. Let's take a quick break. Stan Wong of Scotia Wealth Management taking your questions today on North American large caps as well as ETFs. Back in a moment. Welcome back. We have an email from Vince. His question is, what is your take on utilities? I need income, so I own UMax. That, again, is from Vince. We'll turn that question over to Stan Wong. So this is the Hamilton Utilities yield. Do you like this one? Would you suggest something else?
Yeah, so, broadly speaking, with covered call strategies, I think the attraction is the tremendous yield. You're getting about a 13% yield from this, from a combination of the dividends from the companies within them. We'll talk a little bit about them, and of course, the covered call overlay on top of that. Now, this is called the Hamilton Utilities Yield ETF, but it has other things other than utilities. It has telcos, which some people consider utilities, but they're part of the communication space, and they have CP Rail, which is an industrial and so forth. What I would say is that the attraction is the yield, but we need to look at total return. And often the case for a lot of these covered call strategies, they will underperform the underlying indice or index or whatnot. So as an example, this strategy has been out for just under 3 years, 3 years less 3 months, and it's returned 25% over that period of time, total return with the yield and so forth. If you just held the TSX 60, you'd be up 72%. So I think we always need to understand total return, not just be attracted by the big yield that is shown up front. Certainly, if you require that income and you want a little bit more stability, then this may make sense, but you may be giving up upside.
Okay, so something to consider for Vince. Let's go back to the phone lines. Jacob's on the line. He's in Toronto. Hi, Jacob.
Hello, good afternoon. I would like to ask the guest, please, about Shopify, please, if it's to hold it or just sell it. Thank you very much.
Thank you for the question. Shopify, what are your thoughts?
You know, technology in general has been under pressure. I think there are some names that are beneficiaries of this hyperscaler spending, and some names are neutral. I think Shopify is more of a neutral. Now, the stock has dropped below the 200-day moving average, so we'll have to sort of watch that development. That's not a technically sound type of development. And then the other thing to consider with Shopify is it's always been a little bit pricier than a lot of names out there. And that's the major reason why we have never owned Shopify is because it's always been at quite the extended valuations. Right now, trailing PE is 133 and forward PE is 69 times. So kind of keeps me away from this particular name. I think it might be okay from the perspective of trading this name because it has a very high beta and a high volatile profile, so you can kind of take advantage of some of those movements. But even, on a go-forward basis, price to sales at 11 times next 4 quarters. So kind of puts us out of, the range of what we want to buy in terms of valuations.
Why does it tend to be as volatile or very volatile?
I think partly because it really does cater to the small mid-market businesses. And of course, those businesses are going to be more affected or more quickly affected by changes in the economy. The beta is almost 2 times the TSX index, and it's one of the few, high-profile technology names in Canada.
Got it. Okay, let's go back to the phone lines then. Ghulam's on the line in Toronto. Hi, Ghulam.
Hi, good afternoon. My question is I wanted some exposure to U.S. banks and Europe. So I put some money into ZWK and ZWE about 3 weeks ago. Not doing too well at the moment, but what's your view on it? Was that a good decision, and should I continue holding on to it?
Okay.
Thank you.
ZWK, of course, the BMO covered call U.S. banks ETF.
Yeah, so with ZWK, my preference would be to go to the larger banks. This is more regional banks plus others. So you're getting a basket of different names, including Citizens Group, and you're getting Citigroup and so forth. But I prefer the big banks relative to the regional banks. And you've got a lot of regional banks in here. You're getting about a 7% dividend yield via the covered call aspect of it and also the dividends. But again, more than likely, you're getting a better return, total return long term, by just holding the underlying security. With that being said, or the index, with that being said, I would prefer the larger U.S. banks right now.
Okay. That was for Ghulam. Let's go to Bob. He's in Bowmanville, Ontario, with a question. Hi, Bob.
Good afternoon. Stan, I've asked you about Starbucks in the past. I know you used to own it, then you were out of it. Not sure where you're at now. People who know the story, the new CEO from Chipotle about a year and a half ago. Things have been looking pretty good here recently. When you look at even 6 months number, and even the year-to-date number is up about 20% here. So just kind of your thoughts. Are you in? Are you out? How do you look at it going forward here?
Okay, thank you for the question. Is this a turnaround story that you like, that you're invested in, that you believe in?
I mean, you look at the chart, I mean, it's been everywhere. It's up and down and so forth. You look at the 200-day moving average, it's really been kind of flat, turning up a little bit in the last couple of months, but, really not a big signal to buy at this point. The price has moved above the 200-day moving average. That is good. You talk about management changes, we'll have to see if that's a good sign. It looks like investors do like it thus far. With that being said, I think we're fairly careful on consumer discretionary names today. Simply because we have oil prices, at $90, $100 today, that's going to affect the pumps. And there's a lot of competition around the world against Starbucks, maybe not in the US, but there's a lot of competition from other smaller names in China and so forth. And that's obviously a big market for Starbucks. They've retreated a little bit in terms of their expansion plans there, which tells us something. So I'm pretty cautious on a name like Starbucks. I think that it's great that it's broken above the 200-day moving average, but none of these technical signs is really confirming that we're at a new sort of level that we're breaking out and upside is there.
Do you remember the last time you held it?
It's been a while. I think it's been several years at this point.
Okay.
That was probably before COVID. Well, then it would be more than a few years, and that's when China expansion was very important. They were making headway in there, but that's changed.
Got it. Okay. Let's go to Jim then on the line. He's in Chatham, Ontario. Hi, Jim. Jim, are you there? Okay. It looks like we may have lost that caller. We will take a quick break. We'll be back with a look at Dan's past picks. That's coming up next. Stay tuned. Time now to have a look at past picks from Stan Wong. March 13th of last year are when the picks are from. And at the time, Stan chose Expedia Group, EXPE on the NASDAQ at 157.11 US at the time to 230.35 US today. So 47% upside, 48% total return. Solid returns here. Is this something you've held onto? And do you remember why you chose it last year?
We still continue to hold it. We still like the name. It's actually been a bit volatile. It's been at much higher highs more recently, and then some of the AI disruption fears have kind of moved the stock lower. It has recovered from those lows. It's really about, our AI travel agents and Google's travel tool is going to make travelers bypass online travel agencies. And that's the question about AI disruption with other sectors and industries and so forth. So we still like the name. We still see 20% earnings growth going forward. Global travel demand remains very strong, specifically international markets and leisure markets. Business travel is a little bit slower. But I'd argue that with remote work these days, people can work from everywhere, anywhere, and there's more traveling happening from the business sense that people will just travel and work out of the West Coast. And
let me throw the geopolitical stuff in there, right? A lot of people are wary of Mexico. A lot of people are wary of Greenland at this point, wary of the Middle East. I mean, does that affect a stock like Expedia generally?
I mean, I think some of those things are more near-term impacts, and there's always somewhere else that we can travel to. And with the platform that Expedia has with Expedia.com, Hotels.com, and Vrbo, they've got definite scale. And a lot of these technology upgrades that are happening in Expedia and cost discipline measures are expanding margins for Expedia. And that's why we see that 20% earnings growth rate. So, despite geopolitical things that are happening and the AI disruption, we still like this name. We're very watchful of it, of course. It is a higher beta name, so there's going to be times in which we can say, hey, that's a great profit. It's at 47% right now, but I think at one point it was much higher than that. So we'll keep an eye on this name. It's going to be absolutely high beta going forward as it has been in the past, but we like it.
Okay. Let's get to your next past pick from March of last year. MasterCard, MA on the New York Stock Exchange at $519.83 US. Now to 504 flat US, 3% downside, total return at 2%. This would have been one of the stocks, along with Visa, that were solid for so long. And then last year, I guess, that started to change. What are your thoughts on MasterCard as a pick moving forward?
So we held MasterCard and Visa. We're out of both of those names at this point. So those positions that we sold, really high quality names, strong fundamentals, but the stock became kind of flat. And we were looking at some of those premium valuations already priced into the growth rates, and we took profits in that name. Still, obviously a very high quality name. It's in an industry whereby there's few competitors, which I really do like. Cross-border travel is still helping in the name, but really the name's really been sideways because I think that growth has been built into valuations today. We would revisit it again if there is another opportunity down the road, but for now we have redeployed the capital elsewhere.
Got it. Let's get to your last past pick from March of last year, Netflix. On the NASDAQ, so there was a 10-for-1 stock split November 17th, 890. 17 when you looked at it in March of last year. So 94.98 US is where we are today, 7% upside return and total return. You've held this for some time. It has bounced back since dropping out of the Paramount bid contest there. Are you holding on to this? Do you think it's got some power to come back? It's bounced, but clearly hasn't bounced a great deal.
I would say that this volatility was all due to this chase for Warner Brothers, and now they're going to pick up, I think it was $2.8 billion that they didn't have via the breakup fee. And the market obviously was concerned about this large acquisition and the spending that was happening. And I think that the market really wants to see Netflix continue to organically grow through their original content and through sports deals. They've got the WWE, they've got the NFL during Christmas and so forth. I think that's where Netflix should stay in terms of the wheelhouse. Of course, picking up the Warner Brothers package would have really expanded their content, but they would have been taking a bit of a different direction because they wouldn't have as much money to spend on new content and original content and so forth. So I think this is a bit of a positive development. Obviously, the shares have dropped quite a bit since all this started to happen. But I think their scale, their pricing power, their international markets, the advertising tier has really helped earnings quite a bit. So right now we're in a bit of a penalty box for Netflix, but I think it'll continue to recover. And long term, I think it'll still be the leader.
Competition-wise, is there still anybody close?
Well, I guess Paramount's going to be quite
will
close.
Be eventually,
yeah, will
yes.
be quite close in about a year or so. So that's going to be its next nearest competitor. Before this, there really was no serious competition. I couldn't name Disney Plus as a real equal to Netflix. Paramount had a good lineup, but still not equal to what Netflix provided. So I think the international markets, catering to certain local markets, continue to build original content is where Netflix will excel.
Okay. Let's take another quick break, then we'll get back to your phone calls and your emails when we come back. Stay tuned. Welcome back. Let's go to Marco on the line. He's in Montreal. He has a question today for Stan Wong. Hi, Marco.
Hi. Hello, Mr. Wong, and thank you for taking my show. My call. Pardon me. I have a position in Manulife. I'm just very frustrated. It's gone down $10, and this started all before the war, and that's going on. And I just have a second question. Should I maybe switch over to Great-West Life, which seems to be more stable? Thank you.
Thank you for the question. What's going on with Manulife?
I mean, all the financials have come off slightly, particularly in the insurance space. I think that when you look at something like Great-West Life, you've got a pretty low beta stock, and that's why it hasn't moved as much as a Manulife, although Manulife hasn't moved as much as most other stocks out there. You're getting a 4.3% dividend yield with Great-West Life, good quality assets as well. It's very steady earnings growth type of name. With that being said, if you look at Manulife, it's come right down to the 200-day moving average. So you can perhaps say that there might be a bit more upside near term just because it got oversold and it's right around the 200-day moving average, and it's a very high quality name. 4.3% dividend yield. Beta is going to be a little bit higher, so double that of the Great-West Life, equal to the TSX, so no greater than TSX. But volatility is going to be more than that of GWO at this point. Personally, I think Manulife looks a little bit more attractive if you're buying right now or holding right now. And obviously the scale of Manulife is greater than that of GWO.
So you wouldn't necessarily move the money over?
I don't think so. With that being said, I don't think it's going to be a very big total return change going forward, moving from one name to the other. Okay. They tend to move in tandem to a certain extent.
Got it. All right, let's go back to the phone lines. Carlo is on the line. He's in King City. Hi, Carlo.
Hi, Morella. Hi, Stan. Stan, can I get your thoughts on Kimberly-Clark and the upcoming buyout and, I guess, merger with Kenvue?
Okay, thank you for the question. Do you expect this to bring significant synergy here for this company?
First off, thank you, Carlo, my neighbor. He's in King City, just like I am in King City. I live in King City. You know, with some of these consumer staples names, the only ones that are technically very strong in the large cap space would be Walmart and Costco's of the world. With Kimberly-Clark, I see only about 4% earnings growth going forward. So that kind of takes us out of wanting to own a name like that. We want to see at least high single-digit earnings growth or strong double-digit earnings growth. Kimberly-Clark's 200-day moving average is sliding lower, and the price is sliding lower beneath that as well. It's beneath the 200-day moving average. So I would say that this is a name that I'd be pretty cautious on going forward. We don't own it. Long term, the 200-week moving average is actually sliding a bit. It's been really, really flat. So not a name that I would look at this point. Don't really have much comment on the deal coming, the $40 billion deal coming on. I'm not sure if it's going to be really accretive or whatnot. The market seems to be quite nonchalant about it.
Got it. Okay, let's go to our next caller. Rob is on the line. He's in Montreal. Hi, Rob.
Hi, Morella. Hi, Stan. NVIDIA, long-term thoughts, please. Thank you.
Okay. NVIDIA, we talked a little bit about the Mag 7 and how money's moved away from some of these stocks, but they still have momentum.
NVIDIA is obviously not a hyperscaler. They are not the ones that are saying we're spending $100 billion, $180 billion this year. They are going to be a beneficiary of those spends. And I think long-term, they'll be a major beneficiary of that continued AI infrastructure and build-out going forward. So they are definitely a beneficiary of these names. I think they've been swept into this broadening of market leadership whereby technology is not the leader anymore and other names like industrials and materials and energy is starting to lead. So they've kind of been swept under that sort of technology sector, and the stock's really been kind of flat for a little while at this point. We continue to own it. We like it. I think earnings will continue to grow meaningfully over the next 5 to 10 years, or at least 3 to 5 years. We see earnings growth being well above strong double-digit earnings growth. I see 40% here. I'm actually questioning if that's even correct, but I wouldn't doubt that the earnings growth that I see here is correct. So we see a lot of upside with this name. So, you know,
where would you buy in? Because as you mentioned, it's been going a little bit sideways, you know, trading up and down. It hasn't reached that high of 207, I think it did last year. So where would you buy in?
Yeah, it needs to be part of your portfolio. I think that artificial intelligence is not going away anytime soon, and this company is definitely a benefactor of this build-out. So we see earnings growth of 74% in 2027, 31% in 2028, and a little slowdown in 2029, 13%. Those are still all great numbers. Obviously, you don't want to overweight technology these days just because things are moving to other sectors. Mm-hmm. But within your technology sleeve, I think NVIDIA should be one of those names.
Got it. Okay. Let's move on to our next caller, an email from Jeff. He says, P&G, could I have Stan's analysis of Procter and Gamble? Have you put money in the past in Procter and Gamble?
I don't believe we've ever owned Procter and Gamble. We don't have a lot of weight in consumer staples today. We will talk about one consumer staples name in the top picks, but it'll be one of very few. Procter and Gamble is also, like Kimberly-Clark, pretty low earnings growth forecast going forward. 4.5% earnings growth going forward. So that kind of immediately takes us out of wanting to own a name with that low earnings growth. You think about inputs, costs are rising, energy costs are rising. That's going to impact input costs for a name like Procter & Gamble. It has recently fallen in the last, since early this month, and that's a direct reflection of the fact that oil costs have gone up and energy costs have gone up. So this will impact the consumer staples name like this. Now it's just slightly below the 200-day moving average, but that 200-day moving average has been falling. So technically that structure is not very sound from my perspective. And the 200-week is starting to sort of round down as well. So long-term and short-term technical structures are looking a little bit neutral to weak at this point.
Okay. Let's get to another email then. Sue has written in. She says, what is Dan's opinion about Lululemon? Is it a buy at this price? We had a question earlier this week about Lulu and, where it is today. Would you have faith in it? Some think this is a Canadian company that has done really well, and it's just got to turn things around, right? It's got a following. It's getting a new CEO. Is there a come-around story here for Lululemon?
I think the technical structure continues to look a bit weak. The price is below the 200-day moving average. The 200-day moving average is falling, and then they've got issues such as see-through tights and so forth that are happening with this name, and that's causing the stock to not perform extremely well. Earnings growth is looking to be quite flat over the next few years. So again, that will take us out of the running for owning this type of name. I see maybe a bit of a basing pattern happening now with the stock, but is this going to continue for the next 6 months, 12 months? Who knows? So that would leave me out of wanting to buy this name.
Got it. All right, we'll take a quick break. Back with more of your questions for Stan Wong of Scotia Wealth Management. Again, he'll take your questions on North American large caps and ETFs. Back in a moment. Welcome back. We have an email from Bruce. He said, could Stan Wong comment on the outlook for XRE and the REIT sector in general? I haven't talked about REITs too much lately. Let's start with XRE, which is the iShares, I guess, S&P, which is capped REIT index. What do you think about it?
Yeah, so generally I would be pretty cautious about the Canadian real estate market, just given the uncertainty of the economy, uncertainty of the real estate market, changing immigration situation and so forth. So some of the top names in here would reflect that. Canadian Apartment REIT, RioCan, which is shopping, plazas and so forth. And, you drive by some of these large complexes and there's vacancies that are happening. I've seen Rona stores, empty for months upon months and even a year and so forth. Certainly, you're getting a decent yield from XRE at about 4.87, but I think that the risk of capital is certainly there with just the uncertainty of the market. And if you look at the 5-year and the 3-year numbers, you're only looking at about 2% to 2.5% total return over the last 3 and 5 years. So for me, if we're going to look at REITs, I'd probably look at logistic companies in the U.S., warehouses and data centers and so forth, storage companies perhaps.
Are there data center REITs?
Not specifically now, but I can presume that there will be at some point.
They're coming.
But storage would be important, and where Amazon and all these e-commerce companies are storing, those warehouses are good. Like Prologis would be an interesting name. But generally speaking, we actually have zero exposure to REITs at this point, or real estate for that matter.
Okay. Let's go to our next caller then. Chad on the line in Saskatoon. Hi, Chad.
Hi, Morella and Stan. Stan, I'm looking for some exposure into the junior silver miners sector. If I was going to choose, would you pick SILJ or would you pick SLJY for the covered call aspect of it? I'll hang up and listen. Thank you very much.
Okay. How do you feel about covered calls in the junior miner for silver?
Junior silver miners are always going to be very volatile. As a result of that, you'll probably get a very high covered call option premium being paid to you. And again, I think it goes back to, does the investor really need the income? If you need the income, then sure, use a covered call strategy. But I think typically, 9 times out of 10, you own the underlying security and not the covered call option, where you version of it, you'll do better with just the underlying security. With regards to silver miners, silver's had a tremendous run in the last little while. We hold silver bullion specifically through SLV in the US and SVR in Toronto. I prefer to own the bullion itself because we don't have to worry about poor management or mining operations going bad and so forth. Obviously, with this junior silver miner strategy, it's very, very high beta, but it's done extremely well. If you held it for the last year, you're up 205%. I'd be cautious as to chasing silver and gold these days.
I was going to ask you exactly that.
I actually think that you want to be looking at base metals such as copper, aluminum, zinc, and so forth, iron ore. We own DBB in the US, which is a base metals ETF, and it actually owns specifically the commodities.
Sorry, was that DBB?
Yeah, okay. DBB in the US, which is the Invesco DB Base Metals Fund. And it's basically aluminum, zinc, and copper.
Got it. And that's your way of playing the base metals?
Yeah, I think that typically what happens is that precious metals do very well, and then you turn the baton over to base metals.
Got it. Okay, let's get to the next caller then. Faisal on the line. He's in Toronto. Hi, Faisal.
And good afternoon to both of you. Stan, can I get your opinion on GE Aerospace? Would you be taking a position at this current price? I'll hang up and listen. Thank you.
Okay, thank you for the question. What do you think?
I wasn't prepared for that one. I thought we were going to talk about a different name, but I'll look at it very, very quickly and at least give you some technicals with regards to that one. I think when you look at this type of name, technically it looks okay to me. There's some growth in the GE name at this point, and 200-day moving average continues to move higher, and the long term, the price is above that as well. We're seeing about 15% earnings growth with GE at this point. So not a name that we own, but I do like industrials. We own other industrial names currently, but this is one that we own right now.
Got it. Okay, let's get to an email then from Kay. Kay says, could you compare AltaGas, ALA on the TSX, Pembina Pipeline for a long-term hold? Which way would you go?
So AltaGas would give you a mix of energy infrastructure with a regulated utilities type of space. I think it's roughly 45% midstream, 55% utility. So with the utility component, you're going to get more stability, but probably a bit of a lower, well, it is a bit of a lower dividend than Pembina Pipeline, which is more pure play into the pipelines and infrastructure space. I would prefer the more pure play. I'm not a huge fan of utilities unless they're tied in with AI infrastructure build out. I like Pembina a bit more. You're getting a bit more of a better yield. And they've got contracted cash flow for quite a while, and that'll give you a lot of earnings visibility and revenue visibility as well.
Okay, going with Pembina Pipeline for that question. We are going to take a quick break. We will be back with new top picks from Stan in a moment. Stay tuned. Join us tomorrow for Market Call. Tony Sierro will be with us on the show. He's Vice President and Senior Portfolio Manager at Caldwell Securities. He'll take your questions on North American large caps. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to new top picks from Stan Wong. We're going to start with Loblaw L on the TSX. We talked a little bit about discretionary, which you wouldn't put money in now, but this is more of a staple. Why are you more interested in Loblaw?
Yeah, I thought we'd start off with a more of a defensive idea. I've held this for a very long time. I've never presented it as a top pick, and I really should have because it's done so well. And I think it'll continue to do well. Like when you have uncertain times and uncertain economic conditions, you want essential things, and that's what Loblaws provides. It provides not just groceries, but pharmacy services as well. They are the dominant grocery and pharmacy retailer in Canada. And I like Loblaws, just like I like a lot of our other names, because they meet two criteria. Number one, sturdy earnings growth. And number two, they are in an industry with very few competitors. There's only two other competitors in Canada that compete in the grocery space, and really nothing in the pharmacy space. And when you look at grocery spending, it's inelastic demand, it's non-discretionary spending, so it will continue regardless of what's happening out there, and those revenues are stable even during economic uncertainty. Again, very few operators in Canada. There are only three major operators. Their private label strength is very strong. President's Choice and No Name continues to drive revenue, and also as consumers focus a bit more on value, I think that will drive that a bit more. And then Shoppers is kind of that growth engine that will help it. So
Pharmacy does well, right, for Shoppers?
Yeah, and it's high margins as well, and it's their growth engine.
Got it. Okay, that was Loblaw. Let's get to your next top pick. Rio Tinto PLC on the New York Stock Exchange. It's Rio. What do you like about this mining company, iron ore, copper, aluminum, which seems to be in short supply today?
Yeah, so if we know that AI data centers and electrification will continue, and that's going to be a huge driver going forward, and there's more onshoring, nearshoring that's happening, manufacturing in North America that's increasing, then we need the metals to supply that copper, aluminum, iron ore, and that's what Rio Tinto does. And I think the big growth driver is electrifying the world, or making electrification more stable and building these massive AI data centers. Growth rate of data centers is off the charts going forward. Power grids need to be improved. And also you got to think about EVs, that's growing as well. Electric vehicles is growing as well. You need steel to construct things such as data centers, and just onshoring and nearshoring. You need steel to produce that, and that's through iron ore. So we really like this space. Last time I think I talked about BHP Group, which is also another copper name. Rio has a lot of large, long-term, long-life resource deposits, and that'll continue to supply this big AI build-out.
And where are they based? I know BHP, you mentioned, is Australian, isn't it?
This is a UK company name, so their headquarters is in UK, but a lot of their mining is around the world. A lot of it's actually in Australia.
Okay, good to know. All right, let's get to your last pick, which is Vertiv Holdings, VRT, in New York, and this is an infrastructure play?
Yeah, so still tied to the AI story. It's really shifting the evolution of the AI story, going from the names that are building it to the build-out story. So if you have more and more AI data centers out there, you need stable power, and more importantly, you need cooling systems, and that's what Vertiv is all about. Much of their business is all about cooling systems. AI data centers are 24/7. They do not shut down, so they need to be stable, they need to be cool, and so forth. And they require a lot more power density than traditional computing platforms. So the cooling is extremely important. Lots of backlog in terms of revenue backlog for this company. I think it's about $15 billion moving forward. And these hyperscalers and cloud providers are continually building AI data centers around the world. So it's really mission critical infrastructure. They need to stabilize and cool these data centers.
And you definitely feel like that data center build out is not it's not overspent, right? A lot of investors have been worried about too much money being put in that end. Clearly you don't have that same concern.
I don't think so, but even if it is, it's happening, and Vertiv is a benefactor of that, and so is Rio Tinto.
Okay, so even if they do, they have to invest some money in to get it there.
It goes back to the whole idea of picks and shovels, right? So the picks and shovel companies are the ones that are going to benefit, not necessarily the people that are mining for gold or silver.
All right, got to leave it there. Stan, thanks for coming in. Good to see you.
Great to be here.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.